Question 1. Which of the following best describes the primary difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves a fixed percentage of the premium and loss, while non-proportional reinsurance applies only after a certain threshold of loss. B. Non-proportional reinsurance involves sharing a fixed percentage of the risk and premium, whereas proportional reinsurance allows the reinsurer to cover all losses after a deductible. C. Proportional reinsurance includes excessive loss coverage, while non-proportional reinsurance includes quota share coverage. D. Proportional reinsurance involves excessive loss coverage, while non-proportional reinsurance involves a fixed percentage of the premium. Answer: A. Proportional reinsurance involves a fixed percentage of the premium and loss, while non-proportional reinsurance applies only after a certain threshold of loss. Explanation: Proportional reinsurance, such as quota share or surplus share, involves sharing a fixed percentage of premiums and losses between the ceding insurer and the reinsurer. In contrast, non-proportional reinsurance, such as excessive loss, applies when the loss exceeds a specific threshold, meaning the reinsurer only pays after the ceding insurer has sustained losses above a set amount, known as the retention. This distinction reflects different risk-sharing approaches between the insurer and reinsurer. Question 2. Mr. Thompson is evaluating a potential reinsurance treaty for his insurance company, which specializes in commercial property insurance. He is particularly concerned about the risk of large catastrophic losses, such as earthquakes or floods, and wants a reinsurance agreement that provides coverage for these extreme events. Which type of reinsurance would best address Mr. Thompson's concerns? A. Facultative reinsurance with a stop-loss provision. B. Non-proportional reinsurance with excessive loss coverage. C. Proportional reinsurance with a quota share agreement. D. Facultative reinsurance with surplus share coverage. Answer: B. Non-proportional reinsurance with excessive loss coverage. Explanation: In this scenario, Mr. Thompson's primary concern is catastrophic losses, which are typically unpredictable and can cause significant financial damage. Non-proportional reinsurance with excessive loss coverage is ideal for such events because it provides coverage for losses above a specified retention level. Once the ceding insurer exceeds this threshold, the reinsurer takes over the remaining loss, which is particularly useful for catastrophic events like earthquakes or floods. Facultative reinsurance is generally applied to individual policies or risks, whereas proportional reinsurance is more suited for sharing a fixed percentage of risk and premium, which does not provide the specific protection needed in this case. Question 3. Which of the following statements about the reinsurance underwriting process is most accurate? A. Reinsurance underwriting is solely based on the premium amount that the ceding insurer can afford to pay. B. The primary goal of reinsurance underwriting is to assess the risk exposure and ensure that the ceding insurer has sufficient capacity to handle the anticipated claims. C. Reinsurance underwriting only involves reviewing historical claims data and does not account for emerging risks such as climate change. D. The reinsurer's underwriting process is primarily concerned with the financial health of the ceding insurer rather than the quality of the risks being ceded. Answer: B. The primary goal of reinsurance underwriting is to assess the risk exposure and ensure that the ceding insurer has sufficient capacity to handle the anticipated claims. Explanation: Reinsurance underwriting focuses on evaluating the risks being transferred from the ceding insurer to the reinsurer. The process assesses the type, frequency, and severity of risks to determine whether the reinsurer can cover these risks effectively. This includes the evaluation of exposure to catastrophic events, emerging risks such as climate change, and the overall capacity of the ceding insurer to manage future claims. It is not solely based on the premium or the financial health of the ceding insurer, although those factors are considered as part of a broader risk management strategy. Therefore, the correct answer is that the goal is to ensure the ceding insurer can handle its risk exposure while the reinsurer assumes their share of the responsibility. Question 4. In the context of reinsurance, what is the primary difference between quota share and surplus share reinsurance? A. Quota share reinsurance involves a fixed percentage of premiums and losses being shared, while surplus share reinsurance covers losses above a specific retention level. B. Surplus share reinsurance is more commonly used in non-catastrophic events, while quota share reinsurance is applied in catastrophic events. C. Quota share reinsurance covers a fixed amount of risk, while surplus share reinsurance covers losses based on the size of ceding company's original exposure. D. Surplus share reinsurance involves the reinsurer covering 100% of the losses, while quota share involves the reinsurer covering only 50% of the losses. Answer A. Quota share reinsurance involves a fixed percentage of premiums and losses being shared, while surplus share reinsurance covers losses above a specific retention level. Explanation. Quota share reinsurance is a type of proportional reinsurance where the ceding insurer and the reinsurer agree to share premiums and losses at a fixed percentage, regardless of the size or nature of the risk. In contrast, surplus share reinsurance is for proportional reinsurance that allows the reinsurer to assume coverage for losses that exceed the ceding insurer's retention limit, which is typically a portion of the original risk. This provides greater flexibility in managing larger risks by transferring excess exposure above a retention level. Question 5. Which of the following best describes the role of a reinsurance broker? A. A reinsurance broker negotiates the terms and conditions of reinsurance contracts but does not provide advice on risk management. B. A reinsurance broker acts as an intermediary between the ceding insurer and the reinsurer, helping both parties assess risk, negotiate terms, and arrange coverage. C. A reinsurance broker is only involved in facultative reinsurance transactions and does not participate in treaty reinsurance agreements. D. A reinsurance broker is responsible for underwriting the reinsurance policies on behalf of the reinsurer. Answer B. A reinsurance broker acts as an intermediary between the ceding insurer and the reinsurer, helping both parties assess risk, negotiate terms, and arrange coverage. Explanation. A reinsurance broker serves as an intermediary between the ceding insurer and the reinsurer. They play a crucial role in facilitating the negotiation of reinsurance contracts by helping the insurer assess risk, determine appropriate coverage, and terms that meet both parties' needs. Brokers do not underwrite reinsurance policies or solely focus on specific types of reinsurance. Instead, they advise on the best course of action, manage relationships, and negotiate agreements. They are involved in both facultative and treaty reinsurance transactions. Question 6. Mr. Sanders is considering entering into a reinsurance treaty with a reinsurer for a small but rapidly growing property insurance company. Mr. Sanders wants to ensure that he is only paying for coverage when his losses exceed a certain threshold. Which type of reinsurance agreement would best suit Mr. Sanders' needs? A. Quota share reinsurance with a stop-loss provision. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer B. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is the most appropriate choice for Mr. Sanders' company because it provides coverage for losses that exceed a specified retention threshold. This means that the reinsurer only pays after the ceding insurer has incurred losses above the defined amount, which ensures that the insurer pays for catastrophic or large claims only when they surpass the retention level. The stop-loss would also be applicable, but is more of a specific feature, while excessive loss covers losses above a certain amount, directly aligning with Mr. Sanders' needs. Question 7. Which of the following factors has the greatest impact on reinsurance pricing? A. The number of brokers involved in the reinsurance agreement. B. The historical performance of the ceding insurer in terms of claims. C. The size of the reinsurer's capital reserves. D. The regulatory environment in the reinsurer's home country. Answer B. The historical performance of the ceding insurer in terms of claims. Explanation. The pricing of reinsurance is heavily influenced by the claims history of the ceding insurer. A history of frequent or severe claims indicates higher risk exposure, which leads reinsurers to charge higher premiums to compensate for the potential future losses, while other factors like broker involvement, capital reserves, and the regulatory environment roles in the overall reinsurance transaction. They do not have as direct an impact on the pricing model as the ceding insurer's claims history. High frequency or large magnitude of claims will typically result in higher pricing to account for this risk. Question 8. What is the key benefit of stop-loss reinsurance for an insurer? A. Ensures the insurer will not incur any losses from catastrophic events. B. It provides coverage for losses above a specified retention limit, but only after a certain threshold has been reached. C. It limits the reinsurer's liability to a predetermined amount regardless of the loss size. D. It allows the reinsurer to take over the underwriting process of the insurer's policies. Answer B. It provides coverage for losses above a specified retention limit, but only after a certain threshold has been reached. Explanation. Stop-loss reinsurance helps insurers by limiting the overall losses they might incur. It works by covering losses once a predetermined threshold or retention is exceeded. The reinsurer's coverage kicks in after the insurer's own losses reach this threshold, ensuring that the insurer is protected from excessive claims. Is still responsible for a portion of the risk. This is particularly useful for managing the volatility of claims across portfolio of policies. Question 9. Which of the following is a key consideration when reinsurers evaluate the solvency of a ceding insurer? A. The ceding insurer's adherence to national insurance laws. B. The profitability of the ceding insurer in the previous year. C. The ceding insurer's claims handling procedures and efficiency. D. The ceding insurer's premium retention ratio and loss reserves. Answer. D. The ceding insurer's premium retention ratio and loss reserves. Explanation. When reinsurers evaluate the solvency of ceding insurer, they focus on the insurer's premium retention ratio, which indicates the proportion of premium retained after ceding reinsurance, and loss reserves, which represent the funds set aside to cover anticipated claims. These factors are critical for understanding whether the ceding insurer can meet its obligations. Healthy premium retention ratio and adequate loss reserves signify strong financial stability, which is key consideration for reinsurers when deciding to enter into treaty agreement with ceding insurer. Question 10. Which of the following best describes the impact of catastrophic events like earthquakes on the reinsurance market? A. Catastrophic events typically lower reinsurance pricing due to the high frequency of claims. B. Catastrophic events may increase the cost of reinsurance and lead to stricter terms in reinsurance agreements. C. The reinsurance market is not affected by catastrophic events as reinsurers spread the risk across many policies. D. Catastrophic events have no significant impact on reinsurance pricing but affect the underwriting process. Answer. B. Catastrophic events may increase the cost of reinsurance and lead to stricter terms in reinsurance agreements. Explanation. Catastrophic events such as earthquakes, floods, or other large-scale natural disasters can significantly increase the cost of reinsurance. These events cause a surge in claims, which in turn makes reinsurers more cautious. To mitigate potential losses, reinsurers often increase their pricing and impose strict on new agreements. This is particularly true for non-proportional reinsurance agreements like excessive loss, which are designed to protect against large losses from catastrophic events. Reinsurers may also be more selective in the risks they are willing to assume in the aftermath of such events. Question 11. Which of the following is an example of facultative reinsurance? A. A primary insurer cedes all its property policies to a reinsurer. B. A reinsurer agrees to cover a specific policy from an insurer for an individual risk. C. A primary insurer transfers a portion of its entire book of business to a reinsurer. D. A reinsurance agreement automatically applies to all of the primary insurer's policies. Answer. B. The reinsurer agrees to cover a specific policy from an insurer for an individual risk. Explanation. Facultative reinsurance involves the transfer of a single, specific risk or policy from an insurer to a reinsurer. Unlike treaty reinsurance, which covers an entire portfolio of risks, facultative reinsurance is used for individual, often high-risk situations that the primary insurer wants to offload. Question 12. Which of the following types of reinsurance agreements allows the ceding company to cede risk over a set period of time for a specified portion of the risk? A. Facultative reinsurance. B. Treaty reinsurance. C. Excessive loss reinsurance. D. Quota share reinsurance. Answer. B. Treaty reinsurance. Explanation. Treaty reinsurance involves a long-term agreement where the ceding company automatically cedes a portion of its risks to the reinsurer. This type of reinsurance covers a specific portion of the insurer's portfolio or book of business for the duration of the treaty, regardless of the occurrence of specific risks. Question 13. What is the primary advantage of using excessive loss reinsurance? A. It helps to spread risk across the entire insurance portfolio. B. It offers protection for large, unpredictable claims that exceed a certain threshold. C. It allows for the ceding of all losses below a specific retention level. D. It limits the reinsurer's exposure by agreeing to cover fixed percentage of losses. Answer. B. It offers protection for large, unpredictable claims that exceed a certain threshold. Explanation. Excessive loss reinsurance is designed to protect the insurer from large, unpredictable claims that surpass A specific threshold. This type of reinsurance helps mitigate the financial impact of catastrophic events and ensures that the insurer does not face excessive losses from extreme events. Question 14. Which type of reinsurance contract is typically used to protect an insurer from the accumulation of losses during a specific period, such as a year? A. Catastrophe reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Stop loss reinsurance. Answer D. Stop loss reinsurance. Explanation. Stop loss reinsurance is typically used to protect an insurer from excessive total losses over a specified period, such as a year. It covers the cumulative amount of losses that exceed a predetermined limit, ensuring that the insurer's overall losses do not exceed certain threshold. Question 15. Which of the following would most likely be the primary concern for a reinsurer when evaluating an insurer's portfolio? A. The geographic location of the insurer's operations. B. The financial strength of the insurer's policyholders. C. The overall risk exposure and claims history of the insurer's portfolio. D. The insurer's marketing and sales strategies. Answer C. The overall risk exposure and claims history of the insurer's portfolio. Explanation. When evaluating an insurer's portfolio, reinsurers focus on the overall risk exposure and the historical claims experience of the insurer. This helps reinsurers determine the potential risk exposure, which impacts pricing and terms for the reinsurance agreement. Question 16. What is the main feature of a quota share reinsurance agreement? A. The reinsurer agrees to cover losses only above a certain threshold. B. The reinsurer assumes a fixed percentage of premiums and losses from the ceding insurer. C. The reinsurer covers the entire book of business of the ceding company. D. The reinsurance agreement applies only to specific types of insurance policies. Answer B. The reinsurer assumes a fixed percentage of premiums and losses from the ceding insurer. Explanation. In quota share reinsurance, the reinsurer agrees to accept a fixed percentage of both the premiums and the losses from the ceding insurer. This agreement is typically applied to a portfolio of policies, allowing the reinsurer to assume a proportional share of the insurer's risks. Question 17. Which of the following best describes a reinsurance agreement that offers protection against claims arising from a specific large event? A. Proportional reinsurance. B. Catastrophe reinsurance. C. Facultative reinsurance. D. Treaty reinsurance. Answer B. Catastrophe reinsurance. Explanation. Catastrophe reinsurance is a type of excessive loss reinsurance designed to protect against large, often rare, events like natural disasters, e.g., earthquakes, floods. This type of reinsurance is typically triggered when the total losses from a catastrophic event exceed a specified amount. Question 18. Which of the following is a key factor in determining the pricing of reinsurance agreements? A. The reinsurer's operating costs. B. The historical loss ratio of the ceding company. C. The reinsurer's geographic location. D. The number of brokers involved in negotiations. Answer B. The historical loss ratio of the ceding company. Explanation. The pricing of reinsurance agreements is heavily influenced by the historical loss ratio of the ceding company. A high loss ratio indicates that the insurer has experienced significant claims relative to its premiums, making the reinsurer more cautious and likely to charge higher premiums to offset the increased risk. Question 19. What is a primary characteristic of non-proportional reinsurance? A. It involves the sharing of premiums and losses between the ceding insurer and the reinsurer. B. It provides coverage only after losses exceed a predetermined retention level. C. It is typically used for small, frequent losses that do not require high-risk protection. D. It involves reinsurers covering a fixed percentage of an insurer's risk. Answer B. It provides coverage only after losses exceed a predetermined retention level. Explanation. Non-proportional reinsurance, such as excessive loss reinsurance, provides coverage to the insurer only after losses exceed a specified retention level. Unlike proportional reinsurance, the reinsurer does not share a fixed percentage of the risk, but instead covers losses above the retention level. Question 20. What role does a reinsurance broker play in the reinsurance market? A. They underwrite the policies on behalf of the reinsurer. B. They facilitate the placement of reinsurance agreements between insurers and reinsurers. C. They assess the risk exposure of the primary insurer's portfolio. D. They provide the capital needed for reinsurance agreements. Answer B. They facilitate the placement of reinsurance agreements between insurers and reinsurers. Explanation: a reinsurance broker acts as an intermediary, helping insurers find suitable reinsurance solutions by connecting them with reinsurers. They facilitate the negotiation and placement of reinsurance agreements but do not directly underwrite policies or provide the capital themselves. Question 21. Which of the following is an advantage of using a captive reinsurance company? A. It provides coverage at a fixed premium without the need for underwriting. B. It allows the primary insurer to directly control its reinsurance strategy and costs. C. It limits the primary insurer's exposure to high-risk events. D. It allows the reinsurer to control the primary insurer's underwriting decisions. Answer: B. It allows the primary insurer to directly control its reinsurance strategy and costs. Explanation: a captive reinsurance company is a subsidiary established by an insurer to provide reinsurance coverage to its parent company. It allows the primary insurer to have more control over its reinsurance strategy and costs, and it can also help retain profits within the company rather than paying premiums to external reinsurers. Question 22. Which of the following is typically a feature of a facultative reinsurance agreement? A. The reinsurance contract automatically covers all policies issued by the insurer. B. The ceding company must negotiate each individual risk with the reinsurer. C. The reinsurer takes on all of the insurer's portfolio risk. D. The terms of the contract are standardized for multiple types of policies. Answer: B. The ceding company must negotiate each individual risk with the reinsurer. Explanation: facultative reinsurance is negotiated for each individual risk or policy, meaning that the ceding company and the reinsurer must agree on the terms for each specific risk. This type of reinsurance is often used for unique, high-risk situations. Question 23. What is a key difference between quota share reinsurance and surplus share reinsurance? A. Quota share reinsurance involves sharing premiums and losses at a fixed percentage, while surplus share reinsurance is based on the size of the ceding insurer's exposure. B. Surplus share reinsurance requires the reinsurer to cover the full risk, while quota share involves partial coverage. C. Quota share reinsurance is non-proportional, whereas surplus share is proportional. D. Surplus share reinsurance is applicable only to catastrophic risk, while quota share is for all types of risks. Answer: A. Quota share reinsurance involves sharing premiums and losses at a fixed percentage, while surplus share reinsurance is based on the size of the ceding insurer's exposure. Explanation: quota share reinsurance involves the reinsurer accepting fixed percentage of the premiums and losses, regardless of the size of the risk. Surplus share reinsurance, on the other hand, is based on the size of the exposure, where the reinsurer covers losses above the insurer's retention limit, typically covering larger or more substantial risks. Question 24. In which scenario would an insurer most likely use excessive loss reinsurance? A. When the insurer wants to cover all losses for a particular type of policy. B. When the insurer is concerned about covering catastrophic losses. C. When the insurer needs to share premiums with another insurer. D. When the insurer wants to retain a high level of risk exposure. Answer: B. When the insurer is concerned about covering catastrophic losses. Explanation: excessive loss reinsurance is used when an insurer wants to protect itself from large catastrophic losses. The reinsurer provides coverage for losses that exceed a certain amount, offering financial protection in case of major events like natural disasters or other high-loss scenarios. Question 25. What is the typical purpose of catastrophe reinsurance for insurers? A. To help them manage the everyday operational costs of insurance policies. B. To provide protection against the costs of small, frequent claims. C. To provide financial protection against large, unpredictable losses from major events. D. To reduce the number of claims the insurer needs to process. Answer: C. To provide financial protection against large, unpredictable losses from major events. Explanation: catastrophe reinsurance is specifically designed to protect insurers from large, rare losses, such as those caused by natural disasters, e.g., earthquakes, floods. It provides coverage for catastrophic events that would otherwise have a significant financial impact on the insurer's operations. Question 26. Which type of reinsurance agreement is most likely to be used when an insurer wants to cover a highly specific or individual risk? A. Treaty reinsurance. B. Facultative reinsurance. C. Quota share reinsurance. D. Excessive loss reinsurance. Answer B. Facultative reinsurance. Explanation: facultative reinsurance is used when an insurer needs to transfer a specific risk or policy to a reinsurer. This type of reinsurance allows the ceding company and the reinsurer to negotiate terms for each individual risk, which makes it ideal for highly specific or unusual risks. Question 27. Which of the following best describes the term retention in the context of reinsurance? A. The percentage of premiums that the reinsurer keeps after ceding. B. The amount of risk or losses the ceding insurer retains before transferring to the reinsurer. C. The total amount of losses that are covered by the reinsurance contract. D. The amount of capital the reinsurer needs to maintain to cover potential claims. Answer B. The amount of risk or losses the ceding insurer retains before transferring to the reinsurer. Explanation: retention refers to the portion of risk or losses that the ceding insurer is responsible for retaining before transferring the remaining amount to the reinsurer. It's essentially the insurer's deductible in reinsurance contracts, defining how much of the loss they must cover before the reinsurance kicks in. Question 20. In a surplus share reinsurance arrangement, the reinsurer's liability is primarily determined by which of the following: A. The number of claims the insurer receives. B. The amount of premiums the insurer collects. C. The size of the individual risk exposures in excess of the ceding insurer's retention. D. The overall financial strength of the insurer. Answer C. The size of the individual risk exposures in excess of the ceding insurer's retention. Explanation: in surplus share reinsurance, the reinsurer agrees to cover risks that exceed the retention level of the ceding company. The reinsurer's liability is determined by the size of the individual risk exposure, with the reinsurer covering losses that go beyond the ceding insurer's retention amount for each risk. Question 29. What is the primary goal of an insurer when purchasing reinsurance coverage? A. To increase the insurer's market share. B. To eliminate all risk from their portfolio. C. To protect against large unexpected losses and stabilize financial results. D. To provide higher dividends to policyholders. Answer C. To protect against large unexpected losses and stabilize financial results. Explanation: reinsurance helps insurers manage risk by providing financial protection against large and unexpected losses. It allows insurers to stabilize their financial results and maintain solvency, especially in the event of a catastrophic or high loss event. Question 30. Which type of reinsurance arrangement is best suited for an insurer who wants to cover the risk of a small number of very large claims that exceed a certain threshold? A. Treaty reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Quota share reinsurance. Answer C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is specifically designed to protect an insurer from large individual claims or cumulative losses that exceed a predefined threshold. This type of reinsurance covers catastrophic or extreme events, providing a safety net for the insurer against high loss occurrences.